saying don't fight the Fed. What is the Fed? Does anybody know what the Fed is? Yeah, it's the Federal Reserve, but it's a central bank, right? Daniel C. Corrupt Roswell. Yeah, possibly. It's a central bank. Okay, it's a central bank of the United States, right? So whatever it decides, excuse me, all these other banks pay attention to, like the ECB, the European Central Bank, the Bank of England, the Bank of Japan, right? All these people pay attention to what we are doing. Um, the idea of a central bank has its origins in 17th century Europe when the Bank of England was founded, and the Bank of England was the government's banker, and it would issue banknotes, it would lend money, for whatever the government needed, and it also managed the gold reserve. Um, and what these banks try, quote unquote, try to do, right, is they're supposed to be independent, right? They're not supposed to be ruled by the president or Senate or anybody. Just like they're independent, quote unquote. I'm putting quotes here. Understand? um, so there's a lot of central banks all around the world, but I think it was Alexander Hamilton, and he was the first one to create a central bank. That one didn't work. Uh, who's on the $20 bill? I forgot who's on the $20 bill. When our country was brand new, we did not like the idea of a central bank, and we shut it down. And what happened was the U.S. had a bunch of bank panics in the 1800s and in the first decade of the 20th century, and it almost resulted in a complete collapse of the U.S. banking system. But guess who saved it? Can anybody guess? Who quote unquote, not every, now it wasn't just this person, but it was private investors. Yeah, The Creature from Jekyll Island's a good read. Yep. Yeah, J.P. Morgan, right? So not Donald Trump, he wasn't around then, but J.P. Morgan came in and was like, hey, right, well, let's save them. And so at that point, people finally were like, okay, maybe it is better to have a central bank. And the government decided, hey, you know what? Let's have financial stability rather than having J.P. Morgan have to come in here and bail us out, right? Um, any questions so far on this? Does anybody know the date that our last central bank was created? I think I know it. I don't know it. I think it was 1912. Was it 1912 or 1913? I think it was 1913. Yeah. Okay, 1913. Yeah, that's what it was. So we had a pretty good economy, right, during the quote unquote roaring 20s, and the Fed created reserve notes, and that's what we call our currency. We had reserve requirements, right? Does everybody know what reserve requirements are? So like for banks to loan out money, they have to have a certain amount on hand, right? So anyway, they're making up these rules to try to make banking system more reliable. And about 15 years later, what happened? Was it Woodrow Wilson that destroyed the bank? I think was it Andrew Jackson or Woodrow Wilson? Anyway, what happened was you had a Great Depression, right? Yeah, you had the stock market crash. There's a lot of things that happened, but hindsight historians, they all agree that a lot of the policy mistakes made by the Fed contributed to the problem. And so as the economy began to get bad, they didn't ease interest rates, right? They actually rose them. So instead of easing, they raised them. And the reason they did that was because they were more focused on supporting the dollar, which at that point was tied to what? What was the dollar tied to at that point? Gold, right? And so they were more interested in supporting the dollar and discouraging like speculation. And so they didn't, what we call today, they didn't create quantitative easing, they created quantitative tightening, and they didn't support the banking systems when bank runs hit them. And so that's like, okay, well, crap, we made some mistakes. What did we learn? Well, they're like, all right, well, we need monetary policy tools such as influencing interest rates, money supply, so that you can create stable economic growth. And so the authority at that point of the Feds shifted to the Board of Governors. And some of the powers was actually given to the Treasury Department. And at that point, the newly created FDIC, right? Everybody know what the FDIC is? Now, it led to other problems, and we'll talk about those in a second. But do you guys understand everything so far? Yeah, it's the Federal Deposit Insurance Company or something like that. It's making sure that you will get your money if the bank goes under, right? That's what the FDIC is. So what was happening during the Great Depression as well? Well, we what pulled us out of this depression historically? At least this is what I was taught. Maybe they've changed it, when I went to school back in the 1800s, right? Wars started pulling us out, right? Well, when the U.S. started getting into wars, the Fed had to support the war effort. And how would you support the war effort? What would be a way that the Fed could support the war effort? Yep, bonds. Yep, interest rate. Yep. So let's keep the interest rates low, right? Make it easier to issue debt and finance the expansion of the military and to buy government debt. Now, what happens when the Fed buys government debt? So if the Fed says, you know what, I'm going to buy $50 billion of your government debt, where does that debt go? Where do we find that debt? Yeah, it goes to the balance sheet, right? And so you know how you can look at the Fed's balance sheet and it's like, it was at 2 trillion, then 3 trillion, now 7 trillion. When my kids are my age, it'll probably be 57 trillion. Who knows what it'll be then? But it's this balance sheet that has this government debt on it. And so once the war ended, there's a lot of debt on the balance sheet, and the U.S. was becoming extremely powerful. The world power, and so what this did was everybody's coming home, everybody's happy, they're having babies, they're buying things, and what happens? What happens when you create lots of money? People start buying things. What usually happens after that? Yes, inflation, right? So anytime, this is economics 101. You increase the supply of money and you decrease the amount of goods, or even just keep the amount of demand the same. If you increase the amount of money, then prices will go up because there's higher demand, right? That makes sense? And so all of a sudden you now have surging inflation, Do you guys? I don't know how many of you guys were alive back then. Um, do you guys remember some of the height numbers that inflation went to? Like we had some pretty bad inflation readings, right? We had a nine. I think 9.1 was our high here lately. Do you guys remember what some of the highs were back then? Can anybody remember that? Don, how old are you, Don? You must be a smart one. I like that name. 21%. Yeah, it was like as high as 21%. That's crazy, isn't it? Okay, so Don lived through it, right? Yeah. So that's just crazy. Think about that right now. Imagine if we hit a 21% increase. I mean, that's nuts. Um, and so what does the Fed have to do at that point? What would be the step for the Feds to do if they wanted to bring down inflation? Wow, Harry, you got a mortgage in 81 at 18.7? Woo. Yeah, they got to decrease rates, that's for sure. But what else do they have to do? That's part of it. Your mortgage was 24. Wow. Yeah, they're going to increase rates, but what did we just talk about? Where does the government when we buy government debt, where does it go? So they need to do what? They need to decrease their balance sheet, right? And how do they decrease their balance sheet? How does the Feds decrease the balance sheet? Well, they let the yeah, exactly. They let the securities roll off. So, if they have 60 billion, 100 billion every month rolling off, instead of buying more, they're just not going to buy anymore, right? And so that starts to tighten and have less supply of money within the system. Does that make sense? Any questions on this? What happened during this time is you had the government fighting with the Fed officials about what was happening, about what was going on, and what they needed to do. Um, and ultimately, what happened at the time was you saw the need for the central bank to be independent, right? And so everybody's like, all right, you are the Treasury Department and the Fed established like the precedence of being operated, quote unquote, again quote unquote, independently, free from political pressure from the president or whomever, right? Again, just keep in mind I am air quoting here, independent. Um, so anyway, um, who who was the president? I think it was Johnson. Yeah, I think it was Lyndon. I think it was Lyndon B. Johnson. Anyway, if unemployment starts going through the roof, right? And so Lyndon Johnson, I think it was Lyndon Johnson, was saying, "Hey, we've got to make a priority to not only maintain control of inflation, but keep unemployment under control." Does that make sense? So when they were fighting against unemployment over price stability, then what you have is inflation gets anchored in, right? And there needs to be that balance, and that's what the Fed's trying to do right now. So, what do we call that? What does the Fed call it when they talk about employment? This word they use every time they use employment. They say our mandate is blank employment and price stability. Does anybody know what word I'm talking about there? They always say it's the same word. They say over and over. It's maximum, right? They want maximum employment and price stability, right? And then it was Volcker. How many of you guys have never heard of Paul Volcker? Put a 4 in chat if you've never heard of Paul Volcker. You guys have never heard of Paul Volcker? Okay, so Paul Volcker is talked about a lot because he came in and did the hard work that was necessary. And those interest rates that everybody was talking about when they bought a house, well, that was because Paul went in there and he literally jacked up rates over and over, and it wasn't working. And so he just got sick of it and was like, "All right, we're going to 20%." He jacked the interest rates all the way up to 20% and was like, "All right, everybody, buckle the f up because we're gonna feel some pain," right? And so, because they let inflation become anchored, you had to do some really drastic stuff, right, to bring it back down to where they wanted it. And so, anyway, Paul Volcker, he was the quote unquote savior of that time, helped bring inflation down. And one of the other things that the Fed decided to start using during that time was more communication. Like there hasn't always been these FOMC meetings that everybody watches and waits for the Fed Chair Powell to get up and talk, and they didn't go on the Tonight Show and say, hey, here's what we're planning to do or whatever. But they've become more vocal about what they're doing, and this will tie into when I was talking about only twice in the history that I know of when I went back and checked was when the Fed did something different than what the market was pricing in. And so, like, the reason that is because they talk to us. We know what they're going to do before they do it because they're talking to us, right? And they're letting us know. And what we do on the market is we're trying to interpret it of, hey, they're going to cut, they're not going to cut, blah, 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 blah. And so what is the dual mandate of the Feds? Well, it's price stability and maximum sustainable employment, right? Those are the objectives of it, okay? So we've been going 17 minutes faster here. So does anybody know how the Fed is structured? Have you guys ever heard of, regional banks, bank presidents, um, the Federal Reserve banks, the Board of Governors, all that stuff? Like how does that all fit? You know what I mean? Like, does this make sense? You guys understand? Let's just go through it real quick. There's basically kind of like the government of the U.S. There's multiple branches so that you can get more ideas from different sections of the country, understand what's going on as a whole. And so there's 12 regional banks, right? They're located all over. And each of the banks will give information that helps implement the policy for the entire country. And they also do loans and stuff. The banks, they kind of play a regulatory role for that region. They'll do research within their region. They'll put out reports about manufacturing. Everybody know the Atlanta wage tracker, right? So each one of them has reports that they'll put out to help keep track of what's going on, and each one of them has its own leadership, and that includes 6 directors, and they're elected by a member of the commercial banks within that specific district, and then 3 directors representing the interest of the banks themselves, right? And then 3 more tasked with representing the public's interests, right? Can anybody, no cheating now, can anybody name all 12? So each 12 needs to have a bank president, right? And that's what they do. They select the bank president. But I don't think I can name all 12. There's one in Boston. There's one in New York. There's one in Philadelphia. There's one in Atlanta, Chicago, San Francisco, Dallas, Kansas City, St. Louis, yeah, there's another one. I'm missing what, one, two, three? I'm missing three. Um, anyway, hold on one sec. Charlie's talking. You got those 12. Well, does anybody not know? Or here, what is the Board of Governors? The Board of Governors, it's led by 7-member Board of Governors, which includes a chair, right? A vice president, or a vice chair, I'm sorry. And then you got your 5 board members. So the chair and the vice chair, who picks the chair and the vice chair? Oh yeah, Cleveland. Yep, that's another one. Who picks the chair and and vice chair? I keep saying that. Yeah, you got it. The president, right? And then after the president picks them, what do they have to do? So they get picked by the president, and then they go in front of the Senate, right? They get asked all these questions. They talk to them, and they're like, oh, "Okay, great. Yep, you're good. We'll put you in, right?" And so, um, Joe, I don't think it's 10 years. I think that's wrong, Joe. I think it's 4 years. I'm like 99% sure it's 4-year terms, but I could be wrong. So check that out, Joe. Check it out for me, Joe. See if it is 4 years. Google it or something. But I think it's a 4-year term, um, right? And then what the other? How are the other 5 board members selected? And maybe this is what you're talking about. The other 5. I thought their term length was longer. Like I thought it was 14 years. And so maybe that's what you're getting confused with. So maybe that's what it is. But anyway, they're elected or they're brought in for much longer. Um, and each member of the board of governors also votes as a member of the 12-member federal open market committees. So you guys know when we look at the dot plot and all these, and the 7 is joined by 5 of the presidents of the regional Fed banks. So you got those 7 people, and then you got presidents of the 5 that create the 12, right? And so no cheating, no cheating. Okay, here comes a question. Let's see who can be the first one to get it. Let's see who's got the fast hands. Who is our chair? You're not trying if you're not trying. Yeah, exactly, Mel. Jerome Powell, right? Um, who else? Can you guys name anybody else on the board? We talk about them in here, right? We'll talk about some that are much more positive or dovish and all that kind of stuff. Yep, you got Bostic, right? What is Bostic? Is Bostic more positive or negative most of the time? Is he dovish or hawkish? Yep. You got Bowman, Barr, Waller. I can't remember the others off the top of my head. Yeah, you can literally you could probably Google right now who are the who are the Doves and who are the Hawks on the board, and they'll have something like that. I've seen that before. So with the Fed trying to either make the economy heat up or cool down, they use different tools to do that. Right? They want to encourage businesses to spend, to expand, or do the opposite. Right? Now, can the does Jerome Powell go into the banks and say, "All right, banks, you've got to start lending"? all right, like for me, all right, Donnie, we want you to buy more subways and get more sport clips. Is that how it works? Do they all send out like mass emails for election and they're like, hey, you need to start spending money, right? No. So how do they do it? Like what tools do we have, right? We talked about a little bit above them. We've got the interest rate, right? Now they have what that's called the Fed fund. You'll hear the term Fed funds rate, right? Federal funds rate, which is the interest rate that does what? It's this interest rate is what depository institutions charge to lend each other reserve balances on an overnight basis, right? So that affects other lending rates charged by the banks, right? Because you don't want one to be super high and then everybody puts their money there, and one to be super low and all that kind of stuff. So lower rates generally lead to higher level of spending, stimulating the economy. And that encourages people to get jobs. People get more jobs. They start spending more money. They start consuming, and higher rates do the opposite. And it also helps to lower inflation because people lose their jobs, companies stop growing, then inflation goes down, the demand for goods go down. Now, if you had to guess, what would you say is the main tool that the Fed has for influencing the federal funds rate? If you had to say this is the main tool, what would you think it is? And this is key to understand because I talked to you guys about this a couple months ago, and I don't know if you guys got it or not, but this was the time when I said, guys, it's time to load the freaking boat, right? It's the purchasing and selling of the U.S. Treasury securities on the open market, right? So like if the Fed is, let's just say they're buying, I'm gonna make this like insanely crazy. If the Fed is buying $2 trillion of securities every month, what does that mean that we have in our system? Well, yeah, we've got debt. That's true, but I'm talking about like physically, we have more cash, right? We've got the liquidity. So, how would you guys like to have $2 trillion every month given to the economy? Wow, how fast could we grow, right? Woo, we would just go crazy. Inflation would go through the roof, right? We'd be at like 100% inflation all the time. But man, that would be a lot. And so the strongest thing that they have is to push cash into the economy, into the system. So that by buying the securities, it's giving money to the banking system, which gives them more money to borrow and lend, right? And so in turn, what does that do? Well, that lowers the banks borrowing from each other, interbank borrowing, right? And then that lowers the federal funds rate, right? And then the opposite's true too. Selling securities reduces reserves, making it more likely the bank will need to borrow, blah, 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 blah. And do you guys remember when I got on here, it was Nate was on, and I said, hey, Nate, there's something important I need to talk to the room and you about. And I went over what Jerome Powell just said. He said, we're going to stop letting all of our funds run off, and we're going to start buying $35 billion of months of securities. So now that after everything that I just told you, what does that mean? If the Fed was letting, $100 billion run off every month, and they said, you know what, we're going to stop doing that, and we're going to pump in $35 billion every month. What does that do physically for everyone, all of us? Yeah, it gives us literally 35 more billion dollars in the system, right? And so, do you guys remember when I said I'm not betting against $35 billion of the Feds pumping money into the market, right? And I said now is the time to buy, buy, right? And so, what happened? Well, of course, the economy starts doing better. Things start going through the roof. Is inflation going to go back? That's ultimately what they're trying to do. Oh, nope, inflation seems to be still coming down. Are we going to hit a soft landing? Looks like it. You know what I mean? Like maybe, maybe not. And then the Fed also lends money to banks and other institutions on an overnight basis, right? They charge a rate for that. It's called the discount rate. The lending facility, they basically, if a bank's like, man, I'm low on cash. I need 20 billion in cash, right? Or whatever. 20 million. Then they're like, all right, let me get 20 million from you. And what does that do? That stabilizes the banking system so that one individual bank can't have a bank run on it, right? Like, I forgot, what was the name of the last one that happened? The one in, I think it was San Francisco. Right? Anyway, you know, you're borrowing money to individual banks. You're sending money out to those individual banks on a discount rate. And if that rate is lower than the Fed funds rate, what would banks do? Well, they're going to rather borrow from the Feds than other banks, right? And that's, anybody ever heard of the term IORB, right? Interest on reserve balances. This is how the Fed can set a floor on the Fed funds rate. They can change the interest rate that it pays reserves on balances that banks keep in the actual Federal Reserve. So if this rate is ever above the Fed funds rate, banks would incentivize to keep more money in the reserves on deposit at the Fed, right? Because you're going to earn more interest than giving it to some other bank. And then that would diminish the willingness to lend to other banks, which would cause what? The Fed funds rate to rise, right? And flip-flop, both of them. Does that make sense? And another tool that they can use that they don't use a lot is they can change the reserve requirements. I honestly don't know what it is now, but when I was borrowing money, it was a 1 for 10, which means for every $10 that they loan out, they need $1 worth of reserve. And so if you change that, if you make it less or more, you can also change how much a bank can lend, right? So if you say, all right, it was 1 for 10, but now it's 1 for 20, well, now they can lend out twice as much. Or if they said, well, it's now you got to have 2 for 10, well, now they can only lend out half as much. This one's not used very often. Why do you think this one's not used very often by the FOMC? Yeah, SVP. That's the one I was thinking about. The reason they don't do this is because you're literally messing with the stability of a bank. Yeah, it could cause a lot of chaos, right? If all of a sudden they said, you know what, it was 1 for 10, but now you only need 1 for 20. Well, what happens if they get hit with a bank run? Well, now they've only got 1 for 20 instead of 1 for 10. Could really mess up the balance of all the banking systems within each other. Like, instead of needing to borrow 2 million from that bank, they're like, well, crap, we only have half the money that we once had because we've already loaned it out. So now we need to borrow a lot more. Okay, and so nowadays, what do we get? Well, the way that we keep up with the feds is we have the FOMC meeting. They come out and they give us a, hey, here's what's going to happen with the federal funds rate. They have a Q&A with Papa Powell, right? They come back and they say, here's what we think is going to happen in the future. And so you've got a lot more visibility on the feds now because they come out and talk and give us ideas. They give us the dot plot of what they think is going to be happening in the future. And that's it. That's how the Fed has become so important. And what's so important about what's happening now is, first off, if you were able to recognize what I told you about the Fed's pumping $35 billion into the economy, well, what do you think that's going to do? That's going to make things go up, and it did. Okay, well, now not only are they pumping the $35 billion into the economy every month, but they're also going to reduce the interest rate, right? Which is going to increase the ability of borrowing and the cheapness of borrowing, which helps who? It helps smaller mid-cap companies because they need to borrow money. They need cheap money so that they can grow. And that's why, to me, I think the IWM by the end of the year could be at 250. Let September the cut come out. Little questionable depending on what happens with the election. As long as there's not like a civil war, everything goes back to normal. And I think we could be at 250 at the end of the year on the IWM because this is backed by interest rate cuts, more money in the system, which in turn, this is what causes this. Your earnings on your small caps are going to be going up, right? So their EPS, their earnings per share, is going to go up because it's costing less to borrow the money that they need. More people have money in the economy to spend at these places, and so their earnings results go up as the big caps are coming down, like on NVIDIA. NVIDIA did, I think, 10% quarter over quarter versus 50, which is still amazing, but it's not 50, right? So that's what I'm talking about when I'm saying the small caps are going to start going up, small mid caps, things like XLE, regional banks, right? KRE, I'm sorry, KRE, regional banks, what else would benefit? Like home builders, right? XHV. These are the areas that I'm looking at for end of year moves. Any questions on any of this, guys?